January 2025. The Federal Reserve has raised interest rates to 5.5%, the highest in 23 years. Inflation is still above 3%. Your rent is up 30% since 2020. Groceries cost 25% more. Gas prices swing wildly. Fed Chairman Jerome Powell stands at a podium and says, "We have the tools to bring inflation down." But 2 years into aggressive rate hikes, inflation isn't going away. And now something worse is happening: the tools stopped working. The Federal Reserve is out of ammunition. This is the story of why central banks, the most powerful economic institutions in the world, have lost control. And what happens next will reshape your financial future. Welcome to History Media. We break down the systems, patterns, and hidden forces shaping our world, backed by research, not hype. If you want to understand how the economy actually works, not what politicians tell you, hit that subscribe button and turn on notifications. And if this video helps you understand what's really happening with your money, leave a like. It helps more people find this content. Now, let's talk about why the Federal Reserve's playbook just stopped working. Here's what should have happened. When inflation rises, the Federal Reserve raises interest rates. This makes borrowing expensive. People spend less. Businesses invest less. Demand falls. Prices come down. It's Economics 101. It's worked for 40 years. Except this time, it didn't work. March 2022, Fed starts raising rates. Inflation at 8.5%. January 2023, rates at 4.5%. Inflation at 6.4%. July 2024, rates at 5.5%. Inflation at 3.2%. January 2025, rates still 5.5%. Inflation stuck at 3.3%. Jerome Powell keeps saying, "We will bring inflation to our 2% target." But here we are, 3 years later, and it's not happening. The same thing is happening in the UK. The Bank of England raised rates from 0.1% to 5.25%, the fastest increase in 30 years. Inflation came down from 11% to 4% and got stuck. Two of the world's most powerful central banks. Same playbook. Same problem. The tool is broken. Why? The answer takes us back to March 2020, when central banks made a decision that changed everything. And we're still living with the consequences. Let me show you exactly what happened. March 2020. COVID-19 shuts down the global economy overnight. Stock markets crash. Unemployment hits 14%, Great Depression levels. The economy is in free fall. The Federal Reserve has two choices. Option 1, let the recession happen. Millions lose jobs, businesses collapse, but inflation stays low. Option 2, print massive amounts of money, keep rates at zero, prevent economic collapse, but risk inflation later. They chose option 2. And they didn't just print a little money. In 8 weeks, the Federal Reserve created $3 trillion, more than they created in the previous 100 years combined. By 2022, the Fed's balance sheet went from $4 trillion to $9 trillion. The Bank of England did the same thing, printing £450 billion through quantitative easing. In the US, $5 trillion in stimulus. Checks to every American. Forgivable business loans. Expanded unemployment. In the UK, furlough scheme. Eat out to help out. Business grants. All that money flooded into the economy. People had cash. Demand surged. But supply chains were broken, factories closed, ships stuck at ports, workers at home. Economics 101, too much money chasing too few goods equals inflation. By 2022, inflation hit 9% in the US, highest since 1981. In the UK, 11%, highest since 1982. So the Federal Reserve and Bank of England did what they always do, they raised interest rates. But this time, something was different. The inflation wasn't behaving like it used to. And that's where the limitations start. Limitation number 1, the liquidity trap. Here's how interest rate hikes are supposed to work. Fed raises rates. Borrowing becomes expensive. Businesses delay expansion. Consumers delay purchases. Demand falls. Prices fall. Except that's not what happened. Because during the pandemic, corporations locked in ultra-low interest rates for years. Apple issued bonds at 2.4%. Amazon at 1.5%. Major corporations borrowed trillions at near-zero rates, and those loans don't expire until 2027, 2030, even 2035. American homeowners refinanced into 30-year mortgages at 3%. UK homeowners locked in 2-year fixes at 1.5%. So when the Fed raised rates to 5.5%, who actually felt it? Only new borrowers. First-time homebuyers now face 7% mortgages, but people with existing mortgages don't care. Small businesses seeking new loans get crushed, but Amazon with $50 billion in 2% debt is fine. This created a split economy. Those with old debt are protected, still spending. Those needing new debt are crushed, can't afford anything. So the Fed raises rates, but half the economy doesn't feel it. Consumer spending stays high. Inflation stays high. The interest rate tool is half broken. But it gets worse. Limitation number 2, supply-side inflation. There are 2 types of inflation: demand-side inflation, too much money, people buying too much. Fed solution: raise rates, reduce spending. This works. Supply-side inflation: not enough stuff, supply chain problems, worker shortages, energy costs. Fed solution: raise rates, but this doesn't create more stuff. Doesn't work. Let's look at US inflation right now. January 2025, rent is up 30% since 2020. That's a supply problem, not enough housing. Food is up 25%, supply problem, labor costs, climate, fertilizer. Energy is up 40%, supply problem, OPEC cuts, Ukraine war, refinery limits. Cars are up 20%, supply problem, chip shortage, factory shutdowns. Jerome Powell raises interest rates. Does this build more houses? No. Does this grow more food? No. Does this pump more oil? No. Does this manufacture more semiconductors? No. Raising interest rates does nothing for supply-side inflation. It's the wrong tool for the problem. In the UK, it's even worse. Brexit reduced the labour force by 460,000 workers. Farms can't find pickers. Factories can't find operators. Truck drivers quit. The Bank of England raises rates to 5.25%. Does this bring back workers from the EU? No. You can't solve supply problems with demand policies. And central bankers know this. But it's the only tool they have. So they keep using it, hoping it works. It's like trying to fix a broken leg by taking aspirin. It might reduce the pain, but it doesn't heal the bone. Limitation number 3, the political limit. The Federal Reserve has two jobs, a dual mandate: keep inflation low at 2% target, and maximize employment. But right now, these goals are in direct conflict. To crush inflation completely, the Fed would need to raise rates to 7%, maybe 8%, high enough to cause a recession, spike unemployment to 7 to 8%, force mass layoffs. Millions of Americans would lose their jobs. The housing market would crash. Stock markets would collapse. Retirement accounts would get cut in half. And here's the limitation: the Federal Reserve is technically independent, but it's not immune to political pressure. In 2024, during the presidential campaign, both parties attacked the Fed. Trump said Powell was raising rates too fast. Democrats said he wasn't doing enough for workers. If unemployment hits 8%, Congress will grill Powell in hearings. The president will publicly blame him. The media will call it Fed-induced recession. So the Fed is stuck: raise rates aggressively, cause recession, face political backlash, or keep rates moderate, inflation stays elevated, face different political backlash. The same thing is happening in the UK. The Bank of England is under massive political pressure because high interest rates are crushing homeowners with variable rate mortgages. 600,000 UK households facing mortgage payment increases of £500 or more per month. That's a political crisis. Central banks can't fight inflation if it means political suicide. This is the hidden limitation no one talks about. Monetary policy is theoretically independent, but practically constrained by political reality. So if the Federal Reserve can't fix inflation with interest rates, what happens now? Scenario 1: inflation slowly grinds down over 3 to 4 years. This is the soft landing hope. Rates stay high. Supply chains gradually heal. Labor markets cool naturally. Inflation reaches 2% by 2027. Probability? Maybe 30%. It requires perfect timing and no external shocks. Scenario 2: stagflation, the worst of both worlds. Inflation stays at 3 to 4%. Economic growth stalls. Unemployment rises. This happened in the 1970s. It took 10 years and brutal rate hikes of 20% to fix. The Fed would need a Volcker moment, named after the Fed chair who deliberately caused a recession to kill inflation. Politically nearly impossible today. Probability? 40 to 50%. Scenario 3: the Fed pivots too early. Political pressure mounts. Recession fears rise. The Fed cuts rates before inflation is truly defeated. Inflation roars back even worse, just like it did in the 1970s when the Fed gave up too soon. Probability? 20 to 30%. So what does this mean for you? High interest rates are here for years. Plan accordingly. Inflation will stay above target. Protect your purchasing power. Asset prices will stay volatile. Don't panic, but don't assume quick recovery. The economy will feel weird: high rates, moderate inflation, slowing growth. This isn't normal. But it's not unprecedented. We're living through a fundamental shift in the economic system, from 40 years of low rates and low inflation to a new era of higher rates and persistent inflation. The Federal Reserve's tools were built for the old era. They don't work in the new one. Here's the truth that central bankers won't tell you: Monetary policy, interest rates, money printing, quantitative easing, these are blunt instruments. They worked well when inflation was predictable and driven by demand. But the modern economy is more complex. Supply chains span the globe. Labor markets are tight. Energy is weaponized. Political constraints are real. Fixing this requires more than monetary policy. It requires housing supply reforms, immigration policy changes, energy infrastructure investment, supply chain diversification, wage and productivity policies. Those are political decisions. Congress and Parliament, not the Fed or Bank of England. Central banks are doing what they can with limited tools. But they can't solve political and structural problems with interest rates alone. That's the hidden truth. The Federal Reserve isn't all-powerful. Monetary policy has real limits. And we're living through the moment when those limits became visible. If you want more deep dives into economics, systems, and the hidden forces shaping your world, subscribe to History Media. Hit the bell for notifications. And tell me in the comments, do you think the Fed should raise rates even higher and risk recession? Or hold steady and accept higher inflation? Let me know. Next time, we're investigating why housing became unaffordable, and it's not what you think. Thanks for watching.